Have you ever found yourself just scrolling through headlines, maybe listening to the news, and feeling, oh, well, completely overwhelmed by all the new legislation coming out? Especially when it's something as massive and honestly as debated as the big, beautiful bill. You hear politicians, on all sides saying wildly contradictory things. Promises of economic miracles on one side, warnings of fiscal cliffs on the other. And it just leaves you wondering, okay, but what does this actually mean for my finances? You're definitely not alone in feeling that way, and that's exactly why we're here today. Welcome to The Deep Dive, a special presentation from the DGH News and Information Network. Our mission today, to cut through all that noise, peel back the layers and give you a clear, factual, and impartial analysis of how this one big, beautiful bill, H.R. 1, will truly impact you, the individual, specifically from a tax perspective. We're drawing on a specially generated expert-level analysis that was compiled right here by the DGH News and Information Network. We really designed this as a service for, well, the average person on the street who just doesn't have the time, frankly, to wade through almost 900 pages of legislative text and who, let's be honest, doesn't know exactly what to believe when the political rhetoric gets so intense. So think of this deep dive as your shortcut to being genuinely well-informed. Okay, let's unpack this.
Well, it's fascinating just seeing the sheer magnitude of this bill. Officially, it's H.R. 1, right? And it really represents one of the most significant modifications to the U.S. tax code since the Tax Cuts and Jobs Act of 2017, the TCJA. Many of you will remember that one. This new bill was passed by the House on July 3rd, 2025, and then signed into law by the President pretty quickly on July 4th, 2025. And its aim is really fundamental: to reshape the economic landscape of the country for, well, the next decade at least. It's truly a sprawling piece of legislation, lots of different policy priorities all bundled together.
That's quite a timeline, huh? Passed and signed right before a major holiday weekend.
Mm.
So let's start with the big picture. What was the core vision behind this bill? What were they trying to achieve, and maybe how did something so impactful even get through Congress, especially that quickly?
Right. So at its core, the One Big Beautiful Bill Act, or OBBA as we might call it, had a really clear central purpose. It was mainly to prevent the scheduled expiration of the TCJA's individual and estate tax provisions. Those were all set to sunset, to just end at the end of 2025. If this bill hadn't passed, millions of Americans would have faced a pretty significant automatic tax increase starting next year.
Okay, so stopping a tax hike was job one.
Exactly. The OBBA doesn't just make those TCJA provisions permanent, but in some cases it actually enhances them, makes them a bit more generous, and it uses kind of a dual approach. On one hand, you have new targeted tax relief measures aimed specifically at workers, seniors, and families. On the other hand, it permanently locks in a whole series of pro-investment business tax policies.
Okay, so relief for individuals and incentives for business.
That's the idea. The scale is just immense. We're talking about roughly $4.5 trillion in tax reductions over the next decade. Now, to partially offset that cost, there are also spending reductions built into the bill, totaling about $1.2 trillion.
And where are those cuts coming from?
Primarily, they target social safety net programs. Think Medicaid and the Supplemental Nutrition Assistance Program, SNAP, or food stamps as many know it. And pretty significantly, it also includes substantial rollback of clean energy incentives. A lot of those came from the Inflation Reduction Act. This bill reverses quite a few of them.
Wow. Okay, and the how it passed. You mentioned the speed.
Yeah, the legislative pathway is really important here, and it highlights the political dynamics. The OBBEA was pushed through using a special Senate procedure called budget reconciliation. For anyone not familiar, reconciliation allows certain budget-related bills to pass the Senate with just a simple majority vote, 51 votes, basically.
So bypassing the filibuster, the usual 60-vote requirement.
Exactly. It avoids that hurdle. And using that strategy really underscores the bill's highly partisan nature. It passed both the House and the Senate with pretty much unified Republican support, and just as notably, with unanimous Democratic opposition.
That tells you a lot right there. Clear party lines.
Absolutely. Now, when we get to the top-line fiscal impact, the numbers, this is where the debate gets really intense. According to the official nonpartisan scorekeeper, the Joint Committee on Taxation, or JCT, the tax cuts alone are estimated to reduce federal revenue by about $4.5 trillion over the next 10 years, that 2025-2034 window.
Okay, $4.5 trillion less revenue coming in.
Right. Then you look at the Congressional Budget Office, the CBO, which is also nonpartisan. They factor in those spending changes we talked about. Their projection is that the bill will add approximately $3.3 trillion to the federal debt over that same 10-year period.
3.3 trillion added to the debt. That's a big number.
It is. And this official estimate stands in pretty stark contrast to what the administration is claiming. The administration argues that the bill will actually reduce the deficit in the long run. How? Mainly through faster economic growth spurred by these tax cuts.
Okay, the classic tax cuts pay for themselves argument, or at least partially.
Essentially, yes. But this raises a really important question about, well, differing perspectives on fiscal responsibility and even the economic models people use. See, proponents of the bill often use what's called a current policy baseline.
What does that mean exactly?
It means they start their calculations by assuming the TCJA tax cuts were never going to expire anyway. They treat them as if they were already permanent. So from that starting point, they can claim the OBBBA actually reduces deficits compared to that baseline.
Ah, I see. If you assume the cuts were staying, then making them permanent doesn't add cost, and the spending cuts look like savings.
Precisely. But this specific point is widely criticized by, well, most nonpartisan budget experts, and certainly by Democrats. They often call it an accounting gimmick that hides the true fiscal impact of making those cuts permanent.
Okay, so lots of big numbers, legislative strategy, accounting debates. Let's try to translate this. What does it all mean for the average person listening right now? Who are the biggest winners and losers based on these initial findings?
Okay, let's break down the key findings and the overall distributional impact. Who gets what? For individuals, the vast majority of taxpayers will see some reduction in their income tax liability. That's generally true. This comes mainly from making those lower TCJA tax rates permanent and having that larger standard deduction stick around.
So most people pay less income tax than they would have if the law expired.
Correct. However, it's really crucial to note that higher income households are set to receive the largest benefits in, well, absolute dollar terms. This is driven by things like the big increase in the estate tax exemption, which mostly benefits very wealthy families, and also that temporarily raised cap on the state and local tax deduction, the SALT deduction.
Okay, so while many benefit, the biggest dollar amounts go higher up the income scale.
That's what the analyses show. Businesses in the U.S. are also very significant beneficiaries here. They're getting permanent restoration of some powerful investment incentives. Things like immediate R&D expensing, 100% bonus depreciation. These are designed to give businesses long-term certainty and really encourage them to invest domestically, keep capital and jobs here in the U.S.
Makes sense. Businesses like certainty.
Definitely. Now, stepping back for the overall picture, the net effect of the OBBA, when you combine the tax cuts and the spending cuts, is generally described as regressive.
Regressive. What does that mean in this context?
It means that while the tax cuts themselves are spread pretty broadly across different income levels, many people get something, the spending cuts that help pay for them are highly concentrated. As we mentioned, those cuts hit programs like Medicaid and SNF the hardest, and those programs disproportionately help low-income households.
Got it. So the cuts hurt the bottom end more.
Exactly. The CBO analysis, which is sort of the gold standard for independent scoring, projects that this combination leads to a net loss of household resources for the lowest income quintiles, the bottom 20% of earners. So even if they get a small tax cut, the value of the benefits they lose is larger, meaning they end up worse off overall when you look at the whole package.
Wow, that's a really critical point. Net loss for the lowest earners.
It is. Now, in terms of the broader economy, the outlook is mixed. The bill's projected to give a modest short-term boost to GDP, gross domestic product, a little economic stimulus up front. However, most independent economic models forecast that this positive effect will eventually fade.
Why fade?
The main reason cited is the substantial increase in the national debt that results from these large permanent tax cuts. That increased debt eventually leads to higher interest rates in the long term. And when interest rates go up, it makes it more expensive for private businesses to borrow money and invest. This is called the crowding out effect.
Government borrowing crowds out private borrowing.
Essentially, yes. It dampens private investment and ultimately slows down economic growth over the longer haul. So think of it as maybe a short-term sugar high, potentially, but with a longer-term drag from the increased debt.
Okay, that gives us the essential big picture and a sense of the winners and losers. But what about the actual numbers on, say, my paycheck or the deductions I can claim next year? Let's really drill down into the specific tax changes that hit closest to home for individuals.
Absolutely. Let's get into the weeds a bit. The foundation of the OBBA, and really where the biggest individual tax impact comes from, is making those 2017 TCJA individual tax cuts permanent. Remember, these were all scheduled to expire at the end of 2025. If they had, most people would have seen a noticeable tax increase.
Right.
So first, the individual income tax rates and brackets. The TCJA created a 7-bracket structure with generally lower marginal rates. OBBBA makes that structure and those lower rates permanent. They're locked in now. This single provision is actually the largest tax cut in the entire bill. It stops that big tax hike that was looming for almost everyone.
Okay, so rates stay lower than they would have.
Exactly. Second, the enhanced standard deduction. The TCJA nearly doubled the standard deduction. OBBA not only makes that permanent, but it actually provides an additional enhancement on top of it. For tax year 2025, the standard deduction is set specifically at $31,500 for married couples filing jointly. It's $23,625 for heads of household and $15,750 for single filers and those married filing separately.
Those are pretty big numbers compared to before TCJA.
They are, and they'll continue to be indexed for inflation in the years ahead. What this means for you, the taxpayer, is that millions more people will find filing their taxes simpler. Fewer people will need to go through the hassle of itemizing deductions. And fundamentally, it just lowers your taxable income right off the top.
Makes sense. Simpler filing, lower taxable income for many.
Right. Now, to help offset the cost of that bigger standard deduction and some other tax breaks, the bill also permanently repeals the deduction for personal exemptions. This was also part of the original TCJA structure. So you get the bigger standard deduction, but you lose the personal exemption you used to get for yourself and each dependent. That helps the government recoup some revenue.
Okay, a trade-off there. Bigger standard deduction, no personal exemptions.
Correct. Now, beyond those core elements, the bill includes several provisions specifically aimed at helping families with children. The Child Tax Credit, the CTC, is a really central piece here. Under prior law, the credit was set to drop back down to $1,000 per child after 2025. OBBA prevents that. Instead, it permanently increases the credit to $2,200 per qualifying child. And importantly, its value will be indexed to inflation going forward, so it should keep pace with rising costs over time.
$2,200 per child, permanent indexed. That sounds significant.
It is. But here's where it gets, as you said, really interesting, or maybe contentious, depending on your view. While it's a significant increase in the maximum credit, the bill retains the structure from the TCJA that limits the refundable portion of the credit.
Refundable meaning you can get it back as cash even if you don't owe taxes.
Exactly. And because the refundable part is limited, it means that families with very little or no earned income, often the poorest households with young children, won't actually be able to receive the full $2,200 benefit. They need a certain amount of earnings to get the full credit. This was a major point of debate, this limitation on refundability for the lowest earners.
I see. So the full benefit doesn't reach everyone, particularly the very poor.
That's correct.
Yep.
Then we have something new, a temporary pilot program creating savings vehicles that have been nicknamed Trump accounts. This program is funded only through 2028, so it's temporary for now. Under it, parents of children born before January 1st, 2024, and who are under age 8 can open a special account.
Okay, for young kids born before 2024.
Right. These accounts can receive contributions from various sources, and the bill actually authorizes the Treasury Department to facilitate a government-provided baby bonus contribution into these accounts. The money in the account can grow tax-free, which is nice, but withdrawals made by the child after they turn 18 will be subject to capital gains tax.
Okay. Tax-free growth, but taxed on withdrawal later. And a potential government contribution.
Yeah, it's a new concept. Projected cost is around $17 billion over its short lifespan. Additionally, the OBBBA enhances several existing tax benefits related to child care costs. It expands the tax credit for employers who provide child care assistance. It increases the amount employees can exclude from income for employer-provided dependent care help. That goes up from $5,000 to $7,500. And it also tweaks the regular child and dependent care tax credit to make it a bit more generous for families paying for care.
So multiple angles to make childcare more affordable.
That seems to be the goal, yes.
Well,
Making it easier for employers to offer it and potentially cheaper for families to access it. Trying to put more money back in the pockets of working parents.
Okay. So beyond these family provisions, you mentioned the bill also introduces some new, but importantly, temporary tax breaks specifically for workers. What are those exactly, and what's the catch with them being temporary?
Right, you hit on a really key aspect there, the temporary nature. That's critical to understand. A signature piece of the OBBBA is indeed the creation of 3 new deductions aimed at specific groups in the workforce. But These are only effective for tax years 2025 through 2028. 4 years.
Just 4 years.
Just 4 years. And this temporary setup creates what budget watchers are already calling a new fiscal cliff at the end of 2028. Politically, it allows the bill's sponsors to claim credit for popular new tax cuts now, but with a lower official 10-year cost than if they were permanent. But it also creates enormous political pressure on a future Congress to extend them. Nobody wants to be seen taking away a popular tax break, right?
Right. So it kicks the can down the road, essentially. Creates uncertainty.
Exactly. So if you benefit from these, just be aware their future isn't guaranteed beyond 2028. Okay, what are they? First, there's a deduction for tip income. If you work in a traditionally tipped industry, think restaurants, bars, hospitality, you'll be able to take an above-the-line deduction for up to $25,000 of your reported tip income.
Okay, $25,000 deduction for tips. That could be substantial for service workers.
It could be. However, there's an income limit. The deduction gets phased out reduced for taxpayers with a modified adjusted gross income, or AGI, over $150,000 if you're single, or $300,000 if you're married filing jointly.
Got it. Phased out for higher earners.
Second, for that same 2025-2028 window, there's a deduction for overtime pay. Specifically, you can deduct up to $12,500 or $25,000 for joint filers of the premium portion of your overtime compensation.
The premium portion, meaning the extra amount you get paid for overtime hours.
Exactly. The amount paid above your regular hourly rate. That extra bit is deductible, up to those caps. And this deduction has the exact same income phase-out thresholds as the tip deduction, $150,000 single, $300,000 joint.
Okay, deduction for overtime pay, same income limits.
And third, there's a temporary deduction for interest paid on loans for new automobiles. But there's a catch. The vehicle's final assembly must occur in the United States, so it's promoting domestic manufacturing. This deduction is capped at $10,000 of interest paid, and it phases out at lower income levels. Above $100,000 AGI for single filers and $200,000 for joint filers.
$10K interest deduction for new U.S. assembled cars, lower income cap.
Yeah.
Very specific, targeted breaks, but temporary.
Precisely. Temporary is the key word there.
Now, what about seniors? This has been a big talking point. Proponents of the bill have claimed, pretty loudly, that it effectively eliminates taxes on Social Security benefits. Is that really what's happening, or is the reality a bit more nuanced?
That's a really crucial question because the way this is being described can be, well, a little misleading if you don't look closely. The legislation definitely includes a significant new tax cut aimed at older Americans. And yes, proponents have presented it as fulfilling that promise to end income taxes on Social Security benefits.
So what does it actually do?
Okay, the OBBA introduces a new temporary bonus tax deduction. It's $6,000 per qualifying individual. And like the worker deductions, it's only for tax years 2025 through 2028.
Another temporary one. Who qualifies?
To get this $6,000 deduction, you have to be age 65 or older, and there's an income limit. Your modified AGI can't be more than $75,000 if you're single or $150,000 if you're married filing jointly. Above those levels, the deduction starts to phase out, and it disappears entirely at $175,000 AGI for singles and $250,000 for couples.
Okay, SISK deduction for seniors under certain income limits, temporary. But how does that eliminate tax on Social Security?
Right, here's the key part. The claim that this provision eliminates taxes on Social Security is more of a, let's say, semantic reframing or an accounting outcome, rather than a direct change to how Social Security is taxed. The bill does not repeal or alter Section 86 of the Internal Revenue Code. That's the part of the law that actually makes Social Security benefits taxable in the first place, based on your overall income. That section remains unchanged.
Ah, okay. So the underlying rule for taxing Social Security isn't touched.
Correct. Instead, what happens is this. You take the new $6,000 bonus deduction for seniors. You add it to the enhanced standard deduction we already talked about, $15,750 single, $31,500 joint for 2025. For most seniors within those income limits, their total deductions will now be so high that they simply exceed their taxable income, including their Social Security benefits.
So the deductions wipe out the income, meaning there's no tax owed on the benefits or anything else for that matter.
Exactly. The Social Security Administration and the White House project that this mechanism, the combination of the enhanced standard deduction and this new $6,000 senior deduction, will result in about 88% to 90% of Social Security recipients paying zero federal income tax on their benefits. So it achieves the political talking point, but it does it through a general tax cut for seniors that lowers their overall taxable income, not by specifically exempting Social Security income itself from taxation. It's a clever way to frame it.
Very interesting. A general tax cut framed as eliminating tax on Social Security. Okay. Now, a perennial hot topic, especially in certain states, is the SALT deduction, the state and local tax deduction. It hits homeowners, particularly in high-tax states, pretty hard. What changes does the big, beautiful bill bring there?
Yeah, the SALT deduction cap, set at $10,000 by the TCJA, has been incredibly controversial. The OBBA provides some significant, though, again, temporary relief here. It temporarily quadruples the cap on the SALT deduction. It goes from the current $10,000 per household up to $40,000 per household.
Wow, quadrupled. From 10K to 40K, that's a big jump.
It is a huge jump, but again, temporary. This change is only effective for tax years 2025 through 2029, so 5 years.
5 years this time, not 4. Okay. Any catches?
Yes. While the higher $40,000 cap is broadly available to those who itemize, the benefit of that extra $30,000 deduction is phased out for taxpayers with incomes exceeding $500,000. So it limits the relief for the very highest earners. After this provision expires at the end of 2029, the SALT cap snaps right back to $10,000 per household, adjusted for inflation, presumably.
So big temporary boost for many, especially in high-tax states, but limited for the top earners, and it ends in 2029.
That's the structure. If you connect it to the bigger picture politically, it looks like a carefully crafted compromise. It delivers significant tax relief to upper-middle-class and high-income taxpayers, especially those in high-tax blue states, a group that was really hurt by the original $10 cap and lobbied hard for relief. But the phase-out prevents it from looking like a complete giveaway to the absolute wealthiest. And making it temporary helps contain the long-term cost on the budgeted scorecard.
Makes sense politically. What about wealth and passing assets down through generations? Any significant changes to things like the estate tax?
Yes, there's a major change here, and this one is permanent. It primarily benefits the nation's wealthiest households. The OBBA enacts a permanent large increase in the unified federal estate and gift tax lifetime exclusion amount.
Okay, the amount you can pass on tax-free.
Exactly. Under the prior law, the TCJA, that exemption was temporarily doubled, but was scheduled to snap back down to an inflation-adjusted level of around $7 million per person in 2026. This bill completely prevents that snapback. Instead, it sets the exemption permanently at a much higher level, $15 million per individual.
$15 million per person.
Per person. That means $30 million for a married couple, starting in 2026. And furthermore, this new, much higher amount will continue to be indexed for inflation going forward.
So very few estates will actually pay federal estate tax anymore.
Dramatically fewer. It really shrinks the number of estates subject to that 40% federal estate tax down to just a tiny fraction of the wealthiest families in the country. It's a very significant change for estate planning for the wealthy.
Okay, that covers a lot of the big individual items. Are there any other, maybe smaller but still key individual tax provisions our listeners should be aware of?
Yeah, there are a few other notable ones worth mentioning. First, the Alternative Minimum Tax, or AMT. It's kind of a parallel tax system designed to make sure higher-income folks pay at least some minimum tax. The TCJA raised the exemption amounts for the AMT, meaning fewer people got hit by it. The OBBA makes those higher AMT exemption amounts permanent. This is actually pretty important for preventing millions of upper-middle income taxpayers from unexpectedly falling into the AMT calculation, which can be really complex and burdensome. So that's a permanent relief measure.
Good news for those potentially hit by the AMT.
Yes. Second, charitable deductions. The OBBA creates a new, permanent, above-the-line deduction for charitable contributions. This means people who don't itemize, maybe because the standard deduction is so high now, can still get a tax benefit for their donations. It's $1,000 for individuals, $2,000 for joint filers.
Okay, so even if you take the standard deduction, you can deduct some charity.
Right, it's an incentive for non-itemizers to give. However, there's a small flip side. To help pay for this, the bill also introduces new minimum thresholds, or floors, for deducting charitable contributions for both individuals who do itemize and for corporations. These are based on a percentage of adjusted gross income, AGI. This might slightly reduce the tax benefit of smaller gifts for some itemizers, but the above-the-line deduction is the main new feature here.
Interesting trade-off again.
And finally, as we touched on briefly before, a really significant policy shift is the repeal or phase-out of numerous green energy credits for individuals. The bill repeals, terminates, or speeds up the expiration of many tax credits related to clean energy that were put in place or expanded by the Inflation Reduction Act just a few years ago.
Like which ones specifically?
This includes credits for buying new and used electric vehicles, credits for making your home more energy efficient, and credits for installing residential clean energy property, like rooftop solar panels. This is a very clear pivot away from federal support for these technologies, and it will directly impact consumers who might have been planning to use those incentives to buy an EV or put solar on their roof.
That's a huge change in direction from recent policy. Big implications for consumers in those industries.
Absolutely. It signals a major reorientation.
Okay. Now, while our deep dive today is focused intensely on individuals, it's impossible to ignore that this bill has massive implications for businesses too, and that in turn affects the broader economy, jobs, wages, all of that. What are the really significant incentives being put in place for businesses under this new law?
You're absolutely right. The business provisions are extensive and really form a core part of the bill's economic philosophy. The OBBBA contains several powerful and, importantly, permanent provisions designed to encourage businesses to invest here in the United States. A key element, as you hinted, is a philosophical shift, moving away from the old cycle of temporary tax extenders, where Congress would let breaks expire and then maybe renew them retroactively, creating tons of uncertainty.
Yeah, businesses hated that uncertainty.
Exactly. So this bill aims to establish these pro-investment policies as permanent features of the tax code. The idea is to give businesses the long-term certainty they need to plan and execute major capital projects, knowing the tax rules won't suddenly change on them next year.
Okay, so what are the big permanent incentives?
First, 100% bonus depreciation. This allows businesses to immediately deduct the full cost of certain qualified property, think equipment, machinery, in the year they buy it, instead of depreciating it slowly over many years. This incentive had actually started phasing down after 2022 under the TCJA rules. OBBBA permanently restores it to 100% for property acquired after January 19, 2025. It's a powerful upfront cash flow benefit for investing. And the bill also expands the definition of qualified property slightly to include certain types of manufacturing buildings, giving an extra nudge to domestic production.
Full, immediate write-off for equipment and some buildings. Big incentive.
Huge. Second, immediate R&D expensing. This is another big one. It permanently restores the ability for businesses to immediately deduct their domestic research and development expenditures. This reverses a very unpopular provision from the TCJA that had started forcing companies to capitalize these costs and amortize them over 5 years, which hurt cash flow and was seen as anti-innovation.
Right, I remember hearing complaints about that amortization requirement.
Lots of complaints. So this bill reverses that permanently for domestic R&D. It even provides retroactive relief, allowing companies to amend prior returns. And it creates a very clear incentive to do your research here, because R&D conducted outside the U.S. still faces a much longer 15-year amortization period under this bill.
Okay, strong incentive for domestic R&D.
Very strong. Third, for smaller businesses, Section 179 expensing is enhanced. The amount they can immediately expense for qualifying asset purchases is increased to $2.5 million. It helps simplify things for smaller firms. And fourth, the rules limiting how much business interest expense companies can deduct are made permanently more generous. The calculation goes back to using EBITDA, earnings before interest, taxes, depreciation, and amortization, instead of EBIT, just earnings before interest and taxes.
Yeah.
This basically benefits capital-intensive firms or those with a lot of debt, allowing them to deduct more interest expense.
More generous interest deduction rules. Okay.
Now, beyond those general business incentives, the legislation also provides permanent tax relief for the vast majority of American businesses that are not large C corporations. We're talking about pass-through entities, S corporations, partnerships, sole proprietorships.
Right, that's most small businesses.
Exactly. The 20% deduction for qualified business income, or QBI, which was a key feature of the TCJA for these pass-through businesses, is now made permanent. Without this change, that 20% deduction would have just disappeared at the end of 2025. The bill also enhances it slightly by increasing the income thresholds where limitations on the deduction kick in, meaning more business owners will get the full benefit.
So permanent 20% deduction for pass-throughs, helping many small business owners.
Correct. Now, on the international tax front, the OBBBA makes some pretty significant revisions to the U.S. system. These changes aren't happening in isolation. They're really a direct, and you could say defensive response to the Global Minimum Tax Framework, Pillar 2, that's been developed by the OECD, the Organization for Economic Cooperation and Development.
Ah, the global minimum tax effort. This bill reacts to that.
Yes. The goal here seems to be aligning the U.S. international tax rules more closely with that emerging global standard. Why?
Right.
To protect U.S. multinational corporations from getting hit with extra top-up taxes in foreign countries, and basically to ensure they remain competitive globally under this new international tax regime. It involves changes to things like GILTE, FDII, Beat lots of acronyms, but the thrust is alignment and defense.
Complex stuff, but aimed at protecting U.S. companies operating abroad.
That's the idea. Lastly, we should touch on other business tax changes, which really highlight that stark divergence in federal support between traditional energy and green energy that we mentioned for individuals. This represents a pretty fundamental reorientation of federal industrial policy. Capital is being steered away from renewables and towards, well, fossil fuels or just general non-energy specific business investment.
How?
Well, the bill permanently extends some existing incentives, like the Opportunity Zones Program, QOZ, which encourages investment in low-income areas. It also makes the New Markets Tax Credit, NMTC, permanent, supporting businesses in underserved communities. And it expands the Low-Income Housing Tax Credit, LIHTC, which is key for affordable housing.
Okay, support for community development and housing.
Yes. But contrasting that, as we saw on the individual side, is the major policy reversal regarding green business credits from the Inflation Reduction Act. The OBBEA eliminates, restricts, or accelerates the phase-out of numerous business tax credits for the clean energy sector. This includes credits for things like clean electricity production and investment, and also the Advanced Manufacturing Production Credit, which was aimed at building a domestic clean energy supply chain.
So, actively removing support for the renewable energy industry.
Yes, and this specific move is projected by analysts to have significant negative consequences for the U.S. renewable energy industry, potentially impacting investment, jobs, and our competitiveness in that growing global sector. It's a very clear choice being made here.
Wow, that's a massive shift in economic philosophy laid bare. Okay, let's try to pull all these threads together now. We've talked individuals, businesses, spending cuts, debt. When you step back and look at the whole package, who truly benefits the most? And what are the likely long-term fiscal and economic consequences according to those independent analyses that aren't tied to a political party?
Right. This is where the picture gets really complex and, frankly, very contested depending on how you measure it. If you only look narrowly at the tax changes, you see cuts benefiting people across most of the income spectrum, though skewed towards the top in dollar terms, as we discussed.
But that's not the whole story.
Exactly. Because the OBBBA was passed using budget reconciliation, its tax cuts and its spending cuts are fundamentally linked. You really have to look at them together for a complete picture. And as we've established, those spending cuts, particularly to programs like Medicaid and SNAP, disproportionately harm low-income households. So for the lowest income groups, the projected dollar value of the benefits they lose is often far larger than any modest tax cut they might receive. This results in a significant net decrease in their overall household resources. Any analysis that ignores the spending side is missing a huge part of the story.
So the combined effect is crucial.
Absolutely crucial. Now, looking at specific income groups, again, with that combined effect in mind, high-income households are undeniably the biggest winners in terms of average tax cuts in absolute dollars. Analyses from places like the Tax Policy Center projected the top quintile getting an average cut around $10,950, with the top 1% seeing benefits accumulating to over $1 trillion over the decade. Again, this is driven by the permanent lower top rates, the temporary SALT cap relief, and that permanent huge estate tax exemption.
Okay, largest dollar gains at the top.
Yes. Middle-income households, sort of the middle 60%, are projected to receive average tax breaks somewhere in the range of $500 to $11,750 per year. These gains come mostly from making the TCJA rates and the larger standard deduction permanent, plus the increased child tax credit. So they do see tangible benefits, just not on the same scale as the very top.
A noticeable cut for the middle class, but smaller amounts.
Right. Now, for low-income households, the bottom quintile, the direct tax impact, as we said, is minimal, maybe an average break of around $150. But critically, this small gain is significantly overshadowed by the loss of benefits from those spending cuts. The CBO's comprehensive analysis projected that the bill could cost the poorest individuals roughly $1,600 a year, mainly due to cuts in Medicaid and food assistance.
So a small tax cut, but a much larger loss in benefits.
Precisely. The CBO's official distributional analysis confirms this directly. It concludes that, on net, when you factor everything in, household resources are projected to decrease for those at the bottom of the income distribution because of this bill.
That's a stark finding.
It is.
Yeah.
Now, shifting to the broader fiscal picture, deficits and debt. The OBBA represents a very clear, deliberate policy choice. It prioritizes tax reduction and investment incentives over controlling the national debt in the near term. The result is a substantial projected increase in federal debt. The official CBO projections show the OBBA adding about $3.3 trillion to the deficit over the 10-year budget window, 2025-2034. That net number comes from the roughly $4.5 trillion in tax cuts and $350 billion in new spending, only partially offset by that $1.2 trillion in spending cuts.
So trillions added to the debt is the official score.
That's the official score, yes. Now, we touched on this earlier, but it bears repeating. The controversy around the current policy baseline. Proponents use this baseline, assuming the TCJA cuts were never going to expire anyway. Using that controversial math, they claim the bill actually reduces deficits by almost $500 billion.
Right, the accounting gimmick argument.
That's what critics call it. Most independent budget experts say the CBO score, showing a $3.3 trillion increase in debt, is the more accurate reflection of the bill's actual fiscal impact compared to the law that was actually in place before OBBA passed. Looking longer term, the debt trajectory becomes a major concern in many independent analyses. Models from places like the Tax Foundation project the debt-to-GDP ratio. A key measure of a country's debt burden will rise significantly because of this bill, maybe hitting 175% of GDP in about 35 years, up from a baseline around 162%. Another analysis from the Yale Budget Lab suggests it could push the debt-to-GDP ratio even higher, maybe to 183% by 2054.
Those are staggering levels of debt relative to the economy.
They are. And a big driver of that is the compounding interest costs on all that new debt. It creates a significant fiscal burden for future taxpayers and policymakers.
And what about the economy itself? Growth, wages, investment? Does the bill deliver on the promises of boosting the economy, or do the independent models paint a different picture?
This is really the crux of the economic debate. It hinges entirely on how much you believe in the power of these supply-side tax incentives versus how much you worry about the negative impact of rising government debt. And there's a really stark divide here between the administration's forecasts and those from independent groups. The White House Council of Economic Advisors put out very optimistic projections. They argue the bill's pro-growth policies will be so effective they'll boost long-run GDP by somewhere between 4.6% and 4.9% and raise annual real wages by $4,000 to $7,200 per worker.
Huge potential gains, according to the White House.
Yes, very large. This view relies heavily on dynamic scoring, where they assume the economic growth generated by the tax cuts will create enough new tax revenue to significantly offset the initial cost of the cuts.
Okay, that's the optimistic case. What do the independent models say?
They project much more modest effects, and in some cases, even negative long-term impacts. The Tax Foundation, which is generally center-right and favors tax cuts, projects a more modest 1.2% increase in long-run GDP. Other groups, like the Tax Policy Center or the Penn Wharton budget model, find even smaller positive effects, maybe in the range of 0.4% to 0.7% boost to GDP over the long run.
Much smaller impacts than the White House predicts. Why the difference?
The key difference is how strongly these independent models incorporate the crowding out effect we discussed earlier. They argue that the large increase in government borrowing needed to finance these tax cuts will inevitably drive up long-term interest rates. Higher interest rates make it more expensive for private businesses to borrow and invest. This crowding out of private investment counteracts the positive incentive effects from the tax cuts themselves, leading to slower overall economic growth in the long run.
So the debt drag offsets the tax cut boost.
That's the argument. Some models, like that Yale Budget Lab analysis, even suggest the negative effects of the debt could outweigh the positive effects of the tax cuts, potentially leading to GDP being nearly 3% smaller by 2054 than it would have been without the bill. So, while the administration is betting heavily on a significant economic boost, most independent analyses suggest a much more muted or potentially even negative long-term outcome due to the increased national debt.
Okay, so if you're listening to this and trying to figure out, does this specific benefit apply to me? What are the key eligibility rules people need to know? And critically, when do these different changes actually kick in or expire? This is where the rubber really meets the road for our listeners trying to plan.
Absolutely. Navigating the specifics is crucial, as it's a real patchwork of rules and timelines. Let's quickly recap the eligibility for the main new individual breaks. For the $6,000 senior deduction, you need to be age 65 or older. The full deduction is available if your modified AGI is up to $75,000 single or $150,000 joint. It phases out above those levels. And remember, it's temporary, 2025, 2028.
Okay, 65 plus income limits, temporary.
For the deduction for tip income, you need to be in a traditionally tipped industry. The deduction is capped at $25,000 of reported tips and phases out if your AGI is above $150,000 single or $300,000 joint. Also temporary, 2025, 2028.
Tips workers, income limits, temporary.
Deduction for overtime pay applies to the premium portion of overtime. capped at $12,500 single or $25,000 joint. Same AGI phase-out, $150K or $300, also temporary. 2025-2028.
Overtime premium, income limits, temporary.
The increased $40,000 SALT cap, available to all taxpayers who itemize, but the benefit of the higher cap phases out for incomes above $500,000. This one is temporary too, but lasts a bit longer, 2025 through 2029.
SALT cap relief, income phase-out, temporary through 2029.
And the $2,200 child tax credit. You need a qualifying child with a valid Social Security number. And remember that key point about limited refundability: families need sufficient earned income to get the full credit. This one, however, is permanent.
CTC is permanent, but need SSN and earnings.
Right. So let's summarize the timelines, because this mix of permanent and temporary is really important. Permanent provisions. The big ones are the TCJA individual income tax rates and brackets, the enhanced standard deduction, that $2,200 child tax credit, the $15 million estate and gift tax exemption, 100% bonus depreciation for businesses, immediate domestic R&D expensing, and the 20% QBI deduction for pass-throughs. Those are locked in, providing long-term certainty.
Okay, a core set of permanent changes.
But then you have a temporary cluster, all expiring after tax year 2028. That $6,000 senior deduction and the deductions for tip income, overtime pay, and auto loan interest. And here's where it gets really interesting, again, politically. This setup creates that significant new fiscal cliff right after the 2028 elections. It virtually guarantees that the next Congress and president will face immense political pressure to extend these popular but temporary tax breaks, which means more budget battles, more uncertainty down the road.
Setting up the next big tax fight in 2028.
Pretty much. Other key expiration dates to keep in mind. The $40,000 SALT cap expires after 2029, snapping back to $10,000. And as we discussed, the repeal and phase-out of most of those clean energy credits happens on various accelerated timelines, mostly between 2025 and 2031. That policy shift is happening relatively quickly.
And implementing all of this, it sounds incredibly complex for the IRS and Treasury.
Oh, absolutely. The passage of the OBBBA is really just the starting gun for a massive implementation effort. The complexity, and frankly some ambiguity in the legislative text, means the Treasury Department and the IRS will need to issue a ton of regulatory guidance, new rules, forms, instructions.
What areas need clarification most?
Key areas will definitely include the precise rules for those new Trump accounts for kids, the transition rules for companies switching back to immediate R&D expensing, the details on how the new restrictions on the remaining clean energy credits will apply, and navigating all the changes to the international tax rules. Taxpayers and businesses will be waiting eagerly for that guidance.
Lots of details still to be worked out.
Yes. And on the international front, you can expect the Treasury Department to be very busy talking with other countries, especially within the OECD framework, to make sure the new U.S. rules mesh reasonably well with that global minimum tax structure, avoiding unintended double taxation or conflicts.
Diplomatic work needed too.
Definitely. And finally, the bill also signals some shifts in IRS enforcement priorities. For instance, it retroactively cuts off the ability to file new claims for the COVID-era Employee Retention Tax Credit, ERTC, which has been plagued by fraud. It also gives the IRS more time to audit potentially bad ERTC claims, so a clear signal they're cracking down there. The bill also significantly increases penalties for government employees who unlawfully disclose confidential taxpayer information, aiming to boost privacy protections.
Okay. So after this really deep dive into the One Big Beautiful Bill Act, trying to synthesize everything, what's the ultimate takeaway? What does this massive law really signify, and what does it suggest about the road ahead for our economy and, well, your personal finances?
Well, to try and synthesize it all, the OBBBA is genuinely a transformative piece of legislation. It fundamentally reshapes the U.S. fiscal landscape for at least the next decade, likely much longer. It definitely achieves its main political goal, making those 2017 TCJA tax cuts permanent, which does provide a degree of certainty, especially for businesses and higher-income individuals planning long-term. But, and a huge but, this certainty comes at the cost of a very significant structural increase in the national debt.
Certainty at the cost of debt.
That's the core trade-off. And the bill's architecture clearly creates a kind of hierarchy of beneficiaries. Businesses engaged in domestic investment, particularly capital-intensive ones, and high-net-worth individuals planning generational wealth transfer, they receive substantial permanent benefits designed to encourage specific economic behaviors. But in stark contrast, as we've seen, low-income households generally face a net loss of resources. Their modest, if any, tax cuts are more than wiped out by deep, lasting reductions in the federal support programs they often rely on.
A clear divide in who benefits most versus who loses out.
Yes. The distributional effects are quite clear when you look at the whole package. The legislation is really built on a series of profound policy trade-offs, and these will undoubtedly define its legacy. One core trade-off is basically growth incentives versus the social safety net. Proponents frame it as shifting resources away from government transfers, which they argue can disincentivize work, towards private sector incentives that promote work, saving, and investment. Opponents, however, see it very differently. They view it as a direct transfer of wealth from the nation's most vulnerable populations to the most affluent and to corporations, a policy they argue will inevitably worsen economic inequality and hardship.
A fundamental philosophical divide there.
Absolutely. Another crucial trade-off is short-term stimulus versus long-term fiscal stability. The bill clearly prioritizes the potential for a short-term economic boost through broad tax cuts over the goal of getting the national debt under control. By adding trillions to the debt, it's making a high-stakes gamble. It's betting that the economic growth resulting from the tax cuts will be strong enough to eventually manage that increased debt burden.
A gamble that growth will outpace debt.
Exactly. But as we've seen from most independent analyses, that's a wager that looks unlikely to pay off. The long-term costs of servicing that higher debt are projected to eventually overwhelm any short-term economic gains.
So looking ahead, what does this all mean?
Well, the OBBBA undeniably sets the stage for more fiscal and political conflict down the road. The creation of that new fiscal cliff in 2028, with those temporary worker and senior tax breaks expiring, guarantees that tax policy will remain a central, very contentious issue in the next few election cycles. The massive increase in the national debt will inevitably constrain future fiscal policy choices. A future Congress, regardless of party, will likely be forced to confront some painful decisions, potentially significant tax increases, further spending cuts, or some combination just to manage the compounding interest costs.
So kicking the hard choices down the road, but making them potentially bigger.
That's a fair assessment. And this raises that important question again about the bill's aggressive rollback of clean energy incentives. Doing that now, especially when global competitors are doubling down on green technology investments, could have really lasting consequences for America's economic competitiveness and maybe even our energy independence in the decades ahead. It's a strategic choice with long-term implications. Ultimately, you have to see the bill as a foundational bet on supply-side economic theory. The idea that cutting taxes, especially for businesses and investors, will unleash growth. But it's a bet financed by a substantial increase in public debt and paid for in part by significant cuts to the social safety net.
A truly comprehensive look at a bill that will absolutely shape our economy for years to come. Those trade-offs are stark. What stands out most to you about them, and what might this really mean for, say, future generations who inherit this larger national debt? That's certainly something to think about. Thank you for diving deep with us today into the One Big Beautiful Bill Act. We sincerely hope this deep dive has helped clarify its very complex implications for you and for your family. We appreciate you tuning in to the DGH News and Information Network. Remember, you can always listen to the news, weather, and much more by visiting dghradio.com online radio. You can also request to join our WhatsApp group. That's where you get the news, weather, and other insightful information delivered right to your smartphone. To join, just text Join DGH WhatsApp Group. That's JOIN DGH WhatsApp Group to 1-315-898-1449. Please remember to include your name in that text message because you will receive a call back to verify your membership request. Now quickly, here's our station schedule here on the DGH News and Information Network. Weather updates can be heard at the bottom of each hour daily. That's 30 minutes after the hour. FSN News follows 15 minutes later, right on the 45-minute mark. Other news broadcasts are available 4 times daily. From the USVI, you can hear them at 6 a.m., 12 p.m. noon, 6 p.m., and 12 a.m. midnight. From the BVI, the news is at 7 a.m., 1 p.m., 7 p.m., and 1 a.m. News from the wider Caribbean region is reported at 8 a.m., 2 p.m., 8 p.m., and 2 a.m. And for U.S. and world news, tune in at 9 a.m., 3 p.m., 9 p.m., and 3 a.m. Our historical feature stories come on at 10 a.m., 4 p.m., 10 p.m., and 4 a.m. And Democracy Now! Plays at 11 a.m., 5 p.m., 11 p.m., and 5 a.m., except on weekends when we feature other insightful topics. And don't forget, between all those news reports, we play originally produced Caribbean cultural and Afro-influenced music. From all of us here at the DSHMEC and Information Network, thank you for listening and stay informed.